What's up, OPM Nation? Todd Robinson. At the request of one of our magnificent mentees, I wanted to record this Loom video on our underwriting model, how to use this actual model to underwrite deals. Because once you learn the nuts and bolts of the financial model, you'll be able to underwrite deals in minutes. All right. And you'll know, hey, what price can I offer? And does this meet my buy box? So let's dive in. This is an 88 unit deal in Union City, Georgia. They're all one bedrooms, one bath. They're all 500 square feet. They're 88 units, and we'll talk about this in a little bit. 84 are occupied, so that's about a 95% occupancy rate. Really good, right? The market rent is about $1,100. The in-place rents, that's the rents they're currently getting right now, are $1,000 per unit. So not much of a spread. If you look right here, it's about $100 of a spread. And so that's not really much of a value add deal. There's probably not a lot of meat on the bone, but if we get it for the right price, it could still make sense if the economics work out and the market turns in our favor. So as I mentioned, I need to mention this first. So at the bottom of this model, you'll see there's a summary tab. This has everything that you'll need, basically all the information you put into the inputs tab is summarized and pulled into this tab. So you can use this for your offering memorandum. You can cut and paste, these specific cells that really look good in an underwriting model. There's the acquisition cost tab. Some of these tabs you can manipulate. So anything in blue you can change. And if you change it here, it's going to change throughout the model. This is the input tab. This is where all the data is going to be. Everything that you're going to need to really underwrite the deal, really underwrite the multifamily model is going to be in the input tab because you're inputting the data there. The T12, that is our rent. That's our, our profit and loss. Basically has our income and our expenses and our capital expenditures. I didn't include the details here because I wanted to get to the summary and the nuts and bolts, but to really round out the underwriting, you would want to you can paste the T12 below, input the data, the expense verification once you actually verify it. Because listen, if it's on a T12, that doesn't mean it's verified, right? They could say the insurance cost is $68,000 a month, but you need to see the insurance bill and the insurance loss runs. That's very important. I've seen it time and time again where sellers have just not told the truth on some of these issues. So make sure you verify the expenses in the T12. Your CapEx budget, that's going to be your capital expenditure. Again, this number here can be changed. It can be manipulated, right? But this is where you're going to track your cash, your capital expenditures. Your tax calculation, again, I don't have some of these numbers need to be updated, but it'll calculate your tax for you. Your cash flow tab. This is, again, a very important tab. This shows the month-by-month cash flow based on the current in-place rents and based on what we think we can get once we bump rents up in year one. This particular model requires it to be in year one. So we have our rent here, our concessions, total revenue, vacancy, which you have to account for, and then you got your gross collections. Now, all of these expenses, let me just show you guys real quick. So where am I getting this information? You may be asking yourself. The information is coming from the broker. The broker sends us what's called the T12. And check this out. Here's the T12. This is the actual statement from the seller. And so you'll see in the seller, in this statement, it tracks everything that we were talking about in the total revenue and all of the expenses. Now, I just used the gross numbers over here to the right because that's just easier for me. But you'll pull this information from the T12, which you'll get from the broker. Now you'll notice none of this is in blue. So you're not actually putting in that tab here. You're going to put in that information here in the rent roll because you're going to have, in the input tab, because you're going to have the market rent here, the in-place rents here, and it's just going to calculate how much rent is collected, and then here are your expenses. Now, total other revenue, again, that comes from the T12 because, there's a lot of, here it is, look, other revenue. There's lots of other revenues that these properties generate. And when you generate that revenue, you need to include it in your T12, like administrative fees, deposit, late fees. Look how much they have in late fees. $33,000 in late fees. That's a lot of late fees, and that's income, right? So you want to capture all the other revenue that you see in this particular model. So that ends up being about $96,000. And your expenses, again, back to these categories. R&M, let's see here, repair and maintenance, right? This whole category is repair and maintenance. I just pulled the number from right there. Salaries, I pulled the number from right there. Utility, I pulled the number from right there. Leasing and marketing, you can tell, I pulled the number from right there. So adding all these in will give you the annual amount. It'll give you the per unit amount, which is not really relevant for underwriting, but it's just good information to have. And then the per square foot. And is it a fixed cost, right? 100% these are fixed costs typically. The real estate taxes, very important. We get that number from the tax bill. Actually, we put it here. And we have a tax calculation because it's likely going to go up each year. So you want to build those increases into your model because otherwise you're not going to be accurately capturing the expenses. So also over here, we've got 5 vacant units. This is kind of this is what we call your lease up, right? This is this tab here. We didn't get through the rest of these tabs. You know, when are we going to bring these deals to market? Okay. You know, and in this particular model, it's critical for our underwriting that we bring it to market in the first year, just because of how tight the deal is. Now, actual rent roll, if you wanted to paste the actual rent roll in there, you could. The waterfall tab, again, this will show you your waterfall, right? Your economics for your investors. And then the loan information is how much the loan is, what's the payment, what's the principal, what's the interest rate. Again, all this information is going to flow through the inputs tab. So if we're looking back on the inputs tab, we've got our expenses, we've got our income, right? That's half the battle. Income, other revenue, and our expenses. We have our taxes here. We've got our management fee here. Management fee is 7% of revenue, right? It could be higher, it could be lower. If you find a manager that's at 4%, you want to change that in your model. If we scroll over here, let's see. If we scroll over here, this is going to show you your assumptions, right? Now, your assumptions, again, a huge part of underwriting. Your assumptions are costs that you're assuming, occupancy, which is not assumed, but like your vacancy rate, 10% vacancy rate is pretty high, right? It's probably closer to 6 or 5 or 6, but you want to be conservative. And so this is a way that you're conservative in your underwriting by choosing a higher vacancy rate. That's called stress testing the deal, right? Your concessions, right? 2% of revenue is going to be basically just given away to tenants because you've conceded first month's rent, things like that. Burn off by year 2. Sponsor acquisition fee, 3% acquisition fee. Again, a little rich. If we drop that down to 2, it's gonna increase the deal returns. The management fee is at 1%. Sale in month 5. So this is going to be, estimating that we're going to sell this property in month 5. This is your purchase price, right? The closing costs and fees, if you go back to the acquisition cost tab here, a lot of these we probably don't need, like these due diligence costs. I guess it's $250 a unit times 8. Let's see, times 800. Wait, hold on. I was just pulling up my calendar here. That's 200,000. Anyway, so the cost segregation, not really a cost. You can identify that cost at closing, but some of these costs, again, you can manipulate it to actually meet the actual costs. But this is going to be your important information to analyze this deal. Now, your growth rate, your rent growth rate, 3% per year, pretty healthy growth rate. But again, if you want to stress test that and say the rent's only going to grow at 1 or 2%, you can do that and it'll give you different returns. We'll get to the returns in 1 minute. Here's your loan amount. right? 4,587,000. Your interest rate, again, if you get a lower interest rate, make that adjustment. It's gonna impact the rest of your numbers. Your amortization, always look for an amortization of 30 years, interest only for 5 years. Again, that's huge because again, the debt in multifamily is really just an acquisition tool. It's unlike residential mortgages where you're trying to pay down your principal because you want to build your equity in the home. The debt is really just there to acquire the property. 10 years and then fees, again, you can adjust this. You can adjust this when you get the actual terms. Again, expense verification, make sure you verify everything. Now let's get to the actual return dashboard, and that's what you see right here. So this dashboard typically will change if you put in different prices or different factors in blue. Now, since this is in Google Docs, I'm not sure if it's going to work. But let's say, for instance, we change this purchase price to $7 million. Look what happens. Our project IRR just went down to 12%, right? Sponsored IRR is 18.84%, but your year one cash on cash is nearly 3%. Your 5-year average is 6.14. Investor IRR multiple 11.2. Again, not a very attractive deal. But we were looking at 6,116,000. That is 69,500 per door for an 88 unit deal. Much more attractive deal, right? 60% IRR is not bad. 5-year average cash on cash, 9%. Better than you'll get putting your money in a CD. Sponsor return is obviously very good. But this is where you go back to your brokers and you say, guys, even at 69,500, it is not a deal that a lot of people are going to be worth doing. Now, if we said 88 units times, let's say we went 65,000 a door, the seller will never go for that. But let's just say 5,720. We change this to 5,720. Now we're talking, right? Close to a 19% IRR, 18.39. Project IRR, 23.38. Now, you don't have to necessarily understand the accounting and economics of these returns. This is a part of defining your buy box, right? If you're looking for deals that, average between 16 and, 20% returns, then this would fit your buy box for your investors, right? He's likely, and I just know this broker and this seller, if he's probably going to want 76,000 a door. 6,688. So let's look what that does. 6,688, 12% IRR. See, automatically, boom, not within our buy box. We just can't buy it at that price because we want to provide exceptional returns to our investors. And so that return structure is just not going to work. But I think if we had 69,500 and it's 6,116, again, healthy 16% IRR. So that's now, again, say we adjusted the vacancy rate and we assumed it was 5%. Look at that, 19.8. So you can see how important your assumptions are. Because right now there's 84 units that are occupied out of 88. Hold on, let's see. 84 units divided by 88. That's 95% occupancy, right? So if we just change our assumption to a 5% occupancy, then we're looking at a 19% IRR. Very healthy deal at a 5% vacancy rate. So if you're negotiating with your broker, this is where, say we went to 6.5 million, right? Still down to a 17. So that's where you can play with some of your assumptions, right? Maybe the concessions are only 1%. Doesn't move the needle very much. 2% is probably more likely. Sponsor acquisition fee, that's a lot at closing. We change that to 2%. Look what happens. We lower our acquisition fee. We've got our investor IRR now up to 18%, 22% project IRR. All right. Rent growth rate, 3%, healthy, right? What if it went down to 2%? Boom, look at that. And if we change every year to 2%, it is going to severely, impact your IRR. Check that out, right? So So again, let's go back to 3% just because that's a little bit better. So you get an idea of how important the assumptions are. That's where you're going to do a lot of your negotiating with your broker. And this is going to be the backup for your data, right? And feel free to share this underwriting with the broker and say, look, even at 6.5 million, we're at 18%. We want to be at a 20%, right? Now let's look real quick. Okay, so where were we? We were talking about our our dashboard and how we can manipulate the dashboard. So last thing I want to go through is the waterfall. Again, we can remember this is all the data you need to input for the loan, right? We have revenue, other income, expenses, assumptions, growth rate, loan amount. That's going to all influence your dashboard here. But what are your returns actually going to be to your investors? All right. So in your waterfall tab, this particular deal we have as a 90-10 equity split. Okay. So 90% to investors. We're going to raise capital from 90% of the capital needed from investors, 10% from the sponsor. So the initial hurdle, the cash flow is going to be distributed 90-10. So if you look at, here's the initial. We've got property cash flow of 90-10 up to a 10% IRR. Then it goes 70-30 up to this should be probably 12. Okay. And then here is hurdle 2 is a 15% IRR. Make sure that didn't. Yeah. So here we go. And then after a 15, it goes 50-50. So if this is our initial debit, right? Property, the investors are going to put in 2.3 million. Sponsors are going to put in 232,000. Now, of the 160 that's available in year one, there's $160,000 of cash flow available in year one. And you know that from your cash flow tab. Because if you go back into your year one, this is your cash flow tab. Again, this flows through from the inputs. This is month by month up here, but if you go down here, you have year by year, annual. See, year by year right here. Look at year one. We've got rent, 1.1 million of the revenue, vacancy, total income. We've got all of our expenses right here, taxes, management fee, your reserves. So we've got NOI of 544,000. That's the cash on cash return there of 7.56%. Your debt service for your first year is 360,000. So your cash flow after debt is $183,000. But you've got your management fee. So we didn't talk about this, and I think I've talked about this to you guys in our sessions. But in addition to your acquisition fee at closing, you're going to get an asset management fee along the way. Now, it's not a ton of money. Look, it's only $23,000 a year, but that keeps you really employed, or keeps you, it compensates you for writing your investor reports, checking on the property, basically managing the property manager, right? Managing the manager. So your net cash flow after debt and all your expenses is $160,000, $160,400. Well, let's go back to our waterfall tab. Look, $160,400. How is that distributed? So once you actually acquire the property, you're still going to be using this model, updating it on a weekly or monthly basis when actual data and numbers come through. Because as you see here, we have $164,000. How's that going to be split? Well, we're still hitting our first hurdle. 90% of it's going to go to pay the preferred return. 10% of it, if there's any left, will go to the sponsor. So in year one, sponsor, you're getting your acquisition fee, you're getting your $23,000 of asset management fee, you're going to get a distribution of 16%, right? Year two, there's $240,000 available. How do we know that? Here it is right here. Now this assumes, talking about assumptions, that your rent has increased by, almost $100,000. Well, how are we doing that? Well, guess what? We have a 3% rent growth. So if that 3% rent growth is true, and look here, year one, we're saying, $1,115 per lease. Year 2, 1,149, right? So that's where that increase is going. So if we in fact get that 3% increase, our revenue is going to increase by $100,000. Once the revenue increases, there's more money to split. So investors get 216,000, sponsor gets 24,072, and on and on and on. So you can see here that at the very end in year 5, we have sale proceeds, right? And in the sale proceeds, we've got sale proceeds plus $300,000 of cash flow from the property. So when we sell it, we're looking at about $2.5 million of profit. And then throughout the year, there's about $300,000 of cash flow that we're going to distribute. That's a total cash flow of $2.7 million. How is that distributed? Well, we've got the first hurdle goes to the pref of $2.2 million. Here's the first hurdle here of $161,000. And now the sponsor is getting $324,000 from their initial, as part of their initial distribution of hitting the first hurdle. So you'll see here, and this actually breaks it down a little bit better, because it looks like at the 12% IRR, yeah, see each hurdle is addressed right here. So we got 15 right here, IRR to a 15. And then this calculates your investor IRR, which again comes from, guess what? The input tab, right? So here's your waterfall. The investor multiple, 2.23%. So in that, when you're marketing, and this all ties back into your investor pitch to your investors, because when you say to somebody, look, I'm going to 2x your money, 2.23 in this particular instance, this is where you're getting that information from. You're not making it up. It's coming from your acquisition model and your financial model. We don't really talk, the sponsor IRR is usually really high because you're putting in 10% and you're getting, a ton of money back. So there's not that, we don't really mention that or talk about that to our investors. Obviously, if they ask, we say, what's the sponsor's return? And it's no secret, but the focus is, what are we providing to our investors? Okay. Now the loan tab, again, some of this stuff, this just details each payment, right? So, you don't need to really, you just need to make sure all the numbers are correct. But I love fiddling with the input tab because, we're looking at another deal, and this again will be an SBL loan, a small balance loan. The interest rate on that is probably 6.7%. Look what that just did to our IRR, 19% IRR. So all in all, again, if our assumptions are true, and this is, look, 10%, now you're back to a 15. And so that's when you want to look at the rent roll from the seller for the past, like historical rent roll. Like, can you safely assume a 5% vacancy rate? Probably, but we never know. So this is it, guys. This is going to be your Bible, so to speak, when it comes to investing in real estate and it comes to analyzing deals. So I hope this video has been helpful. I'm definitely going to give it to our student, and I'm going to post it on the school platform and other areas so that you guys can take advantage of it. If you have any questions on any specific tabs or how to use this in general, please let me know. Again, you're going to pull all the data that you're going to need for the entire deal from the rent roll and from the T12, which is the T12 that you get from the seller. Once you have that information, you can plug it all into the inputs tab. Hope you've enjoyed it. Let's go.